If you've ever watched a movie about submarines, there is always that one terrifying scene where they dive way deeper than they are supposed to.
Oh yeah, the metal groans, the bolts rattle, and you just think the whole thing is going to implode.
Right. But surviving that dive, well, that proves your hull is unbreakable. And today we are looking at Chocolate Finance, which is a wealth tech platform that just went through, the financial equivalent of a deep sea stress test.
They really did. And our mission for this deep dive is to explore how this company survived a massive liquidity scare and actually bounced back to, like, massive growth.
Yeah, and we'll look at what their underlying metrics from a recent private IQ update reveal about the hidden costs of your favorite high-yield tech platforms.
Because honestly, back in March 2025, it really looked like their hull was going to crack. I mean, they faced a severe withdrawal episode. It was essentially a run on the bank.
Wait, really? Like a full run on the bank?
Oh, yeah, pretty much. But instead of imploding, they pulled off this incredibly resilient V-shaped recovery. So according to the private IQ report, they actually bounced back to over 1 billion Singapore dollars in AUM.
Wow, over $1 billion. So, flushing out those panic withdrawers makes sense, but what does that actually leave them with?
Well, it leaves a much stickier, high-quality customer base. The crisis basically acted as a filter. It cleared out the short-term arbitrageurs who were, just chasing a quick buck.
Right, the fair weather fans.
Exactly. And more importantly, surviving that outflow without a traditional banking safety net, it really validates their capital light model.
Let's explain how that actually works for a second, because unlike a traditional digital bank that takes your money, holds it as a liability, and then lends it out, Chocolate operates more as an asset manager.
Right.
They don't need a giant vault. They basically just need a pipe to route your funds into a larger pool.
Yeah, which means they don't need a proportional balance sheet expansion just to grow their AUM. They can scale infinitely without getting weighed down by the capital requirements that, well, choke traditional banks.
Okay, so you are painting this picture of infinite capital light scalability, but I am looking at their bottom line, and they reported a 6.5 million Singapore dollar net loss.
Yeah, that is the catch.
Right. So if the model is so incredibly efficient and they have over $1 billion in AUM, where is that cash bleeding out?
So the bleeding comes from a massive hidden price tag on their growth. I mean, they are facing intense structural pressure from licensed digital banks, places like GXS and Marybank.
Because those banks are offering insured yields of up to, what, 3.48%?
Exactly. And Chocolate Finance's model is uninsured.
So to convince users to take that extra risk, they have to sweeten the deal considerably.
Yep. To compete and basically defend their asset base, Chocolate operates what they call a top-up program. So they are deliberately taking a loss to subsidize customer yields.
Wait, so they are effectively paying out of their own pocket to keep that interest spread attractive for their users?
They are, and they are even taking that strategy on the road now. They recently secured a $15 million Series A+ injection from Nikko Asset Management.
Oh, wow. And they use that to launch in Hong Kong in April 2026, right?
Exactly. Which brings us to this really fascinating tension in their private IQ Smart Score. Over this whole review period, their overall score held completely flat at 4.0 out of 5.
But a flat score does not mean nothing happened.
Not at all. It represents a really fierce standoff.
Yeah, because they have this incredible ability to raise capital, scoring a perfect 5.0 plus a 4.7 in management for surviving that crisis. But those high marks are masking the fact that they are, well, fundamentally losing money on a per-user basis.
Right. They have stubbornly low scores of 2.7 in both unit economics and competition. Those subsidized yields are just eating their margins alive. Yeah, and the only metric that actually moved up was market opportunity. It bumped to 4.3, but that is purely because the Hong Kong launch widened their addressable market.
So for you listening, why should you actually care about all this?
Well, if you are parking your own cash in modern, high-yield digital platforms, it is vital to recognize when the yields you are enjoying are being subsidized by the company's venture capital.
Right, rather than actual profit.
Exactly. It is the difference between a self-sustaining ecosystem and a platform running on a treadmill of continuous funding.
Which leaves us with a final thought to really mull over today. If a company's strategy relies on paying out of pocket just to maintain its user base, at what point does scaling into new global markets just mean multiplying unsustainable losses?
That's a great question.
Sometimes a submarine proves its hull can take the pressure, but you still have to wonder how long it can stay at those depths before the air runs out.